The Retirement Trainer with Ed Siddell, a podcast about finding ways to help you become financially fit for your future, no matter what financial shape you're in now. We have the distinct privilege of sitting down with a true titan in the world of finance and media. Steve Forbes is not only a renowned business leader, but also the chairman and editor-in-chief of Forbes Media, a global publishing powerhouse. He's here with us today to discuss his latest book, Inflation, but also to provide unparalleled insights into the current economic landscape. I'd like to welcome the retirement trainer Ed Siddell and Steve Forbes.
Thank you for joining the podcast. I really appreciate it, Steve.
Well, thank you. Appreciate it.
I got to tell you, I loved your book, Inflation. What is it? Why is it bad? And how do we fix it? Honest, I read it a couple of times. I think this should be required reading for everyone in DC.
Thank you.
Yeah. So, I know your time is very valuable. So just kind of jumping right into it. Everyone knows what inflation is. Everyone feels it, at the grocery store, at the gas pumps, at mortgages. They just hit a high of 8% for 30 years. I think credit card rates are now pushing, 25%. So what exactly is inflation?
Well, the thing to keep in mind, and there's a lot of confusion about it, is there are two kinds of inflation. What you might call non-monetary inflation, which is price increases that come out when there's a disruption of production, either from a natural disaster, a drought, a war, or as we saw in recent times, the COVID lockdowns, which disrupted supply chains and sent prices up. And then you have the monetary kind, the traditional kind, which is lowering the value of the currency, the dollar, usually by creating too many of them. And the two get meshed together. Now, the Federal Reserve can't do anything about clogs at ports or something like that, but it can do something about not debasing the value of the dollar. What's amazing in all of this discussion is that there's no reference to the value of the dollar, the integrity of the dollar. And so the Fed has this strange idea, which has been around for a long time, that the way you conquer inflation is by depressing the economy. They don't realize the rising prices are a symptom of debasing the currency, lowering the value of the dollar, not the cause. So, they can depress the economy as they're doing now, bring prices down. But what that means is that when they decide, well, the inflation's away or it's come down, let's stimulate the economy again, they're back in the same old rut.
Yeah. And, I was just looking at the news. The Feds continue to say that they've got inflation under control. I just heard the Atlanta Fed today. I don't know if you saw this, but they actually said that it's under control and they believe that inflation is going to be back down to 2% next year, and we're not in danger of any kind of a recession, and interest rates will fall. So there's so many mixed messages that we continue to hear from Jerome Powell, the Federal Reserve. But number one, I guess there's so many questions in there. So the first one is, why did they even pick 2%? Do you think that that's really even possible to get to 2%? I can't figure it out. The 100-year average is 3.25%.
Yeah, well, what they have done is they picked that 2% out of the air. When the gold standard was abandoned in the 1970s, central bankers were wondering, what metric do we use? So in the 1980s, the Bank of New Zealand, the New Zealand central bank, said, hey, why not 2%? Why 2? Well, 0 is too close to deflation, so let's have a little cushion in there, 2%. And so that's how it came about. More and more central banks adopted it, so now it's a holy writ, and that's how they came up with it. But then that, of course, gets to, how do you measure inflation? Well, we now know there are about at least a dozen ways of measuring this thing. So it's kind of all nebulous. And again, you can have prices rise in a normal market. If people suddenly decide apples are the way to cure all diseases, you'd find apple prices going way up. You find in high tech terrible deflation as the price of memory goes down and down and down. You know, a supercomputer would have cost you 30 million a few years ago. Today, it's over $1,000 for your handheld. Has the same capability of an old supercomputer.
Right.
So is that deflation and bad? No, it's the normal market. Markets tell you what how people value things. So when they try to manipulate, when they allow even 2% inflation, inflation is like a virus. It corrupts the information.
Well, you know what? You're absolutely right. And when you laid it out in your book, I mean, you went all the way back to, empire after empire, going back to 7,000 BC, the Roman Empire, Genghis Khan, the first paper money with the Chinese Empire, and relating it to today. And the reason I bring that up, because we're the amount of deficit spending that we currently have, and the devaluing and debasing of the U.S. dollar. I'm looking at the debt clock right now. A week ago, we were at 33,528 billion. Okay, so right now it's 33,600 and almost 56 trillion dollars. So it's, when we're looking at this rate, I mean, every 8 weeks we're going to be at another $1 trillion. So between now and next year, we're going to be, if my math is right, just doing it in my head real quick, we're going to add another $6.5–7 trillion before the election. I mean, I don't see how they can say that we're going to get down to 2%. I just don't. Inflation is here until we get spending under control. I just don't see it. So what would you recommend?
They can get it down if they depress the economy, but the fact of the matter is the debt is rising. Remember, a year ago, Joe Biden was boasting that he was the deficit fighter. Well, guess what happened? The deficit doubled this year, so you don't hear much talk about the great deficit slayer. Dragons would have loved Joe Biden. He never would have been able to slay anything. But the fact of the matter is that two things on that. One is when the government take resources, when they go into debt, when they spend, that's the key thing, is the spending, which you hit on, is where do those resources come from? They don't come from manna from heaven. They come from the real economy, real resources. And you can get real resources through taxation, through borrowing, and through inflation, which is a hidden tax. It's like a hidden sales tax. Like in Europe, they have the VAT, the value-added tax. You don't see it in the price, but it's embedded in. Well, inflation's embedded in the prices you pay. So we can borrow more, but make no mistake, it hurts the economy. It slows growth. It slows opportunity, which hurts people with the least the most. And then the other thing to keep in mind, which gets no mention at all, is that, yes, the U.S. can continue to borrow at a higher price. But what that does is suck money from the rest of the world. So we're taking resources from ourselves and from the rest of the world for wasteful projects like green projects that end up doing more harm to the economy than good. Fact of the matter is. And we hurt poorer countries. And one of the crazy things is, you think they would have learned after what happened since 2008, when they suppressed the price of money. Remember, that's like rent control. Instead of renting an apartment, you rent money. And in this case, they suppressed the price of the renting of money. And guess what happened? It hurt small businesses because it distorted the market. The Fed was sucking up all the short-term money. So you had the spectacle of Apple becoming one of the most indebted companies in the world, almost 100 billion the last I looked. Now, why would a money machine like that borrow like that? Because the money was free and any interest was deductible. So they could buy in stock, pay dividends. But meanwhile, smaller businesses get hurt. So the whole thing, you thought that, and governments went tremendously in debt since 2008 because it was like money was free. It'd be like us adding, say, $10,000 to a credit card, and the monthly payment went down as they suppressed interest rates. What's not to like about that? Well, now we're finding out there's a lot not to like about that.
The chickens are coming home to roost, as they say, right? I mean, it's you can't have free money for any extended period of time and not expect to have to pay the piper. I mean, that's really the biggest issue. And so Go ahead. I'm sorry.
No, I was going to say it is costing us. And, traditionally, America's had 3.5% average growth rates. Times of war, depressions, whatever, the average has been the best of any country in history. Now it's under 2%. And since 2008, after that terrible recession, normally you'd get a big recovery. Instead, we had anemic growth, less than 2%. So we're at European-style growth rates, which bodes very ill for the future. And also hurts our national security, because then we don't have resources to defend ourselves and to deal with the bad guys in the world.
Well, you know what? That's a great segue into the geopolitical issues that we're facing. And I saw your video on Twitter or X yesterday as well. So, I mean, when we look at all the geopolitical issues that we're facing, we've got one proxy war right now with Ukraine against, Russia and Iran and China, with Israel right now against Hamas and Iran. And now there's a possibility with China and Taiwan. So, I mean, how is that affecting, inflation, the economy, and, from a defense standpoint, because these are really big issues that a lot of people just seem to ignore or they don't understand.
Yes, well, what we should have learned from the 1970s, what happens when you have a weak economy, where people see no real future. Our military was run down. Amazingly, the Soviet Union was seen as the rising power. Communists were getting power in Central America, moving up right into Mexico. We saw what happened in Asia, and Ronald Reagan reversed that. And we need that reversal again, because it's not just us being hurt, it's everyone else being hurt as well. And you mentioned Ukraine. Vladimir Putin wants to put together the old Soviet Union. He wants to run the US out of Europe. And even though he suffered huge setbacks in Ukraine, he's of the opinion, and this is a very dangerous attitude, when they look at our inflation, when they look how we've mismanaged the economy, they are concluding America is a declining power, and that therefore, if they just wait us out, they're going to win, that we don't have the fortitude that we had when we won the 40-year Cold War. So he thinks he's ultimately going to win in Ukraine. That's why the Ayatollahs are on the march. Make no mistake, Hamas would not have done what they did if they hadn't have been trained and given the green light by Tehran. And China, we know what their ambitions are already. They're trying to turn the critical waterway of the South China Sea into a Chinese lake by building those militarized islands. And we let them get away with it. So they think they keep pushing, and so it's going to become a more troubled world. And that's why we got to get our act here at home to show the world, no, we had a detour, but we're back on track again.
All right. So Steve, how would you fix what's going on right now? I mean, that's, you come up with a very good solution in your book. But I mean, what would you do to fix what we're going through right now?
Well, on the home front, first, take that admonition they used to teach medical students, don't harm the patient, and stop harming the economy. I mean, we should not have regulations that banning gas stoves or turning dishwashers into things that take 10 hours to do what could used to be done in an hour, and crazy dumb stuff like that. Cease that stuff and do what Reagan did, cut tax rates, stabilize the value of the dollar, and then rebuild our tattered military, unleash our great technological prowess. There's some great stuff going out there. There's a material now, carbon material, called graphene. It was discovered almost 20 years ago. It's 200 times the strength of steel, has able to pass through electricity at several thousand times better than copper, and other fantastic things. The trouble was it was very expensive to produce. Now they're making breakthroughs to make it affordable. And so you look at something like that, which can vastly extend the strength of highways and have medical applications, make buildings stronger and stuff like that. So when you look at the healthcare side, the time is going to come, if we allow the research to go forward, not have the government kill it, because of a socialized system where you're going to be able to replace hearts and livers and kidneys, like you do a tire on a car. So these fantastic breakthroughs are in the future if we just get things right.
Well, I've been saying this for a long, long time. Everyone says we have a revenue problem and went from that to a spending problem. I've been saying, this isn't a Republican or Democrat thing. I mean, we have a leadership problem is what we have. And all right, so from, an investment standpoint for investors, I mean, where should investors go? Where is there a safe haven? I mean, personally, I like commodities right now. I love oil. I like gold. You mentioned in your book wheat. We were looking at orange juice, OJ. The beginning of the year, I think it was around $28. Yesterday, it closed just under 70. So it's outpacing the S&P. But what are some safe havens that you see right now?
Well, if you're going to go on things like commodities, you really have to do your homework. It's not like buying an index fund and just tossing it on the shelf, so to speak.
Right.
You have to be really in on it and all the ins and outs of supply and demand. But you should always have a little bit of gold, not as an investment, but as an insurance policy. Like you have a homeowner's insurance for, in this case, the depredations, the destructive forces of the government. So you should have some of that. And I prefer in terms of gold mining, but probably just have the stuff itself, the coins themselves, the bars themselves. And in terms of commodities, there are some funds there. But again, you got to do your homework because that is not just inflation, but supply and demand. Mm-hmm. And then two, as everyone has pointed out, look at the dividend stocks. As you know, S&P 500 has the aristocrats of companies that have increased dividends for 25 years or more. Now, that doesn't mean all of them. I think last I looked, there were 63 companies that had that record, but probably at least 10 are not going to do it this year. So you have to have a diversified portfolio. But the nice thing about dividends is, one, you're getting cash, and then two, a company can respond to a different environment and increase payouts in the future, or at least put themselves in a position where they can increase payouts in the future, which is unlike a bond. So bonds, as you know, if you bought some of those cheapy zero coupon bonds, you're way underwater today. So again, unless you're very nimble, I would stick to 2 years or under to park your cash and a little bit of gold and things like that. So you can try to put some armor up, and if you find a special situation, know that 9 out of 10 aren't going to work. But if one does work, you're set in a very good path. But that requires homework as well.
Well, that is great. Well, Steve, I really appreciate you joining the podcast. I know we're right up against it. You've got some other commitments, so thank you so much for joining us. And hopefully you'll join us again. So thank you.
We'll look forward to being with you, and keep up the good fight for sanity, which for some strange reason is in short supply today. That's where the real shortage is. Sanity, common sense.
Common sense. Yes, I agree. All right. Thank you, sir.
Thank you.
Thank you for listening to The Retirement Trainer with your host, Ed Siddell. For our latest retirement news and financial tips, please visit EGSIfinancial.com or follow us on Facebook, Twitter, and YouTube. Thank you for listening to our podcast. We look forward to having you back for our next episode, where we will continue to explore the world of retirement. Until then, please remember to click, like, and subscribe. See you next episode.